Welcome to the Cannon Trading Podcast, where we bring you daily episodes with market updates and periodic deep dives into the world of trading commodity futures and options.
Welcome. My name is John Thorpe, and I'm from the trading pits in Chicago to the last 22 years at Cannon Trading and a registered senior broker. I will be your host today. Today's topic is futures spread trading. I would like to introduce Mark O'Brien, who earned his bachelor's degree from the University of California at Santa Barbara. I've worked with him shoulder to shoulder for the last 22 years and has been a futures broker at Cannon Trading for his nearly 20 plus years in the industry. Mark is considered one of our in-house experts on spread trading, among other disciplines. Mark, there are as many trading strategies as there are species of daisies. One of the strategies you and your clients engage in are something known as spreads. Because our clients are looking for a variety of other trading disciplines to complement their existing trading strategies, can you please elaborate for us on spread trading and what you know a little bit about that?
Thanks, John, for the introduction. And you're right, there are a wide range of approaches to trading the futures markets, from following candlestick or footprint charts, from trading option strategies with names like condors and butterflies. There's just an enormous catalog of trading strategies and tools available for traders to consider.
Such a colorful group of terms in our industry for some of these strategies, aren't they? But you're here to talk about future spread trading. And aside from your experience trading those future spreads, what's so worthwhile about spreads that traders should know about them?
So, first of all, the basic definition of a futures spread is when you have a single position in the market that consists of simultaneously purchasing one futures contract and selling another one. And they're related to each other in some way. So, for example, a long July corn is matched with a short July soybean, or a long June lean hog is matched with a short December lean hog.
Okay, all right. But why bother advancing this strategy? What makes futures spread trading worth looking at?
So, good question. So, you would consider this. Some of the most invested players in futures trading, and you would argue maybe some of the most sophisticated, are large speculators, commercial firms who regularly employ spreads. These are the traders in the futures markets who actually buy and sell the physical commodities we trade. So that would include farmers, ranchers, other food growers, food producers, petroleum companies that either drill for oil or natural gas or refine these products, financial institutions with enormous holdings in treasuries or stocks or currencies, also mining interests in gold, silver, copper, other metals available for trading, and then all of the buyers of these materials on the other side. All these areas of production and distribution employ spreads from time to time as important aspects of their businesses. So spread trade, it's a fundamental and essential part of the commodities futures markets.
So what you're saying then is there's a lot of spread trading going on out there. That's really interesting. But still doesn't answer the question, why bother with futures spreads? Just because they're heavily traded, so are a lot of other markets. The E-mini S&P sees a couple million contracts traded every day, for example. Crude oil's first few contract months see a million or so contracts a day.
Right. And those are hugely liquid and popular markets. So that's a good question. Why would you say, for example, buy an August soybean and sell a November soybean, right? On the surface, that looks like just a knucklehead trade. So 2 points. First of all, futures contracts can become extremely volatile, not just during their U.S. daytime trading hours, but overnight when traders do other things like sleeping. Volume and liquidity can be diminished significantly. So one aspect that we're talking about, future spreads can greatly reduce volatility risk and can be a viable substitute for placing stop orders for a single contract, for example. Also, because of the reduced volatility risk, the exchanges set margin requirements for a lot of these spreads that can be much less than the outright futures position. So, for example, just a current initial margin requirement for August soybeans is right around $2,400. The current total for the spread that we mentioned, that long August, short November soybean spread, is $715.
So that's all well and good, but what advantages come with lower volatility and lower margins? Mark, those qualities by themselves don't seem to make futures spread trading worth pursuing, but buying an out-of-the-money futures option for $200 is also low in volatility and risk. So what say you?
Right, so I get that. So here's where I would start. First, when we go back to who uses spreads that I mentioned, those same large speculators and commercial firms who regularly employ spreads, again, these are some of the most invested players in futures trading. They are employing spreads based on market conditions and events that, and here's kind of the crux of why we like to use spreads. Those events recur at periodic intervals. So I'm going to point out one of the most obvious of these intervals, obviously, is the cycle of weather from warm to cold and back to warm again. For agricultural and energy futures traders, weather and the changing seasons can have an important effect on price movement. So, for example, enormous supplies of soybeans, once they're harvested, they tend to dwindle throughout the year after harvest.
Okay.
The same goes for other agricultural commodities such as wheat, corn, sugar, and cotton. Seasons and weather changes affect energy prices as well. Demand for heating oil typically rises as cold weather approaches, but then it subsides as refiners meet the anticipated demand. Memorial Day, for example, typically marks the beginning of the quote-unquote driving season in the United States, and similarly, a vast number of the rest of the world's population prepares to go on holiday. As a result, gas consumption rises.
That makes so much sense.
So seasons and weather changes are a big part of why we use spreads. They're not the only cycles out there. Cycles in the financial arena can affect related futures markets. So you consider, for example, how one country's fiscal year and tax due dates often are at variance with others, and those are important trading partners. That can have an influence on currency flows and the forces on interest rate sensitive instruments. So, and again, all these forces that we're talking about, they are not 100% predictable, right? Annual cycles ebb and flow. Seasonal patterns don't repeat without fails. They have price activity and tendencies, but they're not always perfect.
Yeah, that sounds very reasonable. There are three types of future spreads. There's an intermarket, an intermarket, or commodity product spread. Do you have a preference for trading any of those, where you trade one leg of a raw product like crude oil and another leg of its products like unleaded gas or heating oil?
So I don't have a preference. We can clarify what these are to maybe help the listener understand. So the intermarket spread is the what we also can call a calendar spread. That's what we've discussed in that soybean spread, where we just simultaneously buy 1 month and sell another month of the same contract. And so that's one of the first ones. A calendar spread typically focuses on changes in the relationship between the two contract months. This is kind of a strategy to take advantage of supply and demand differences between those two times of the year. Intermarket spreads involve buying and selling two different but related futures with the same contract month in order to trade on the relationship between the two products, like gold and silver or wheat and corn. And then commodity product spreads involves buying and selling futures contracts that are related in the processing of commodities, such as crude oil and unleaded gas, or soybeans and soybean meal, or feeder cattle, which are the younger cattle, and live cattle, which are the ones that are on their way to slaughter. So there's no real preference. All these types of spreads are configured for differences in supply and demand between two commodities, even if the commodity is the same for both legs, because, again, seasonally, demand is different at different times of the months. So that means all those kinds of spreads can be configured, and they can all be configured for a bullish or a bearish outlook too.
So what you're saying, instead of me taking an outright long position or an outright short futures position and using a stop order to mitigate capital erosion, you could employ a future spread. In this case, maybe a calendar spread, if you believe a bearish price trend maybe a dominant feature of a particular market. You could structure a future spread for that, right?
Right. And if you sort of piece together what we're talking about, what you're looking for to profit is really the relationship between the legs of a spread. So in most cases, there's going to be a loss in one leg of the spread and a profit in the other. But putting them together, obviously the net is what you're looking for. So if the calendar spread is successful, the gain in the profitable leg will outweigh the loss in the losing one.
So these are exchange created spreads then. So can you explain for us how we actually trade them and how the exchanges treat them?
Yeah, so a couple of details that come into play here, but here's some main points. As you pointed out, in order to be a spread, it has to be recognized by the exchange. Being, say, for example, long cocoa and short copper is not a recognized spread. Being long cattle.
That would be a wild one.
Right. Being long cattle and short hogs is one. The other point regarding how spreads are traded, it does depend on the trading platform that you're using. That's actually kind of important. Many are built so that you can enter the two legs of a future spread simultaneously. Other platforms require that you enter them one at a time, or what we call legging into the spread by placing two separate orders. A small number of futures spreads, even if they're recognized by the exchange, however, do require you to do that, to leg into them, because they are different contract specifications and the spread is calculated for margin's sake, but not executable. So there's that one little exception that you sometimes see.
Right. So in addition to long cocoa and short copper, which is not a recognized spread, you're not going to get a margin break on that kind of spread. Just because you think you're putting a long and a short on doesn't mean you get a margin break, and it's not considered a spread. There's got to be some relatable factor in production and also in usage between these commodities markets in order to be qualified as an exchange-traded spread. Do you have any recommended platforms? Do you have some favorites that you like to use that we offer?
Right. So this is obviously where Cannon Trading is a participant in the business, right? We offer a number of trading platforms out there for our clients. One specifically that we like to talk about and use is our in-house free platform called eFutures. It has a lot of different features and functions to trade a wide range of strategies, but it also has some really good functionality when it comes to trading a spread. And what we'll do at the end of this is we'll put a link in the description of this episode for a demo of that platform, and we also have a video of how to place spreads that we'll also place there.
That's fantastic, Mark, and we appreciate your contributions to Cannon Trading and its history, and taking time away from your busy schedule today to share some thoughts and some insights with our audience today.
Yeah, and I hope this is something that'll pique your interest, because it's another very viable approach to futures trading that has a lot of use out there by some of the big traders, and it should be for speculators too.
Super. If you would like to know more about spread trading, our company, our offerings or services, or if you have a topic that you'd like us to cover in our deep dives, please feel free to drop an email to info@cannontrading.com. Again, that's info@cannontrading.com. And thank you all for listening. Make it a great day.
If you'd like to receive daily support and resistance levels, you can sign up for our newsletter by following the link in the description. Trading commodities, futures, and options involves a substantial risk of loss. The recommendations contained in this podcast are of opinion only and do not guarantee any profits. This podcast is for educational purposes only. Past performances are not necessarily indicative of future results.